If I ate a chocolate bar for every time someone asked me, hey, Serge, when is it time to short stock? When is the recession coming? When is the stock market crashing? When do we get a bear market? I probably weigh about 400 pounds. But I wanted to have a few words today about equity volatility, because I think this is something that's really important to understand. So in talking to a lot of institutional investors that I do on a daily basis, or just people with large accounts, one of the big concerns that's always a question is volatility. And the question is, how do you circumvent that? So the conversation a lot of times isn't so much about when do you short and prepare for a recession bear market, but is what's the instrument to take advantage of that. And so I have two charts that I'm going to show you and kind of make the case why stocks, equities, indices are actually some of the most difficult things to make money of in bear markets. And there's a very specific reason for that. So let me flip the chart or the camera and you'll see for that. And I think this may take people some time to get used to, because it's not often talked about into the retail community. In fact, probably never, to be honest with you. But let me kind of give you a bit of an idea on this. I'm going to flip the camera. Here we go. Okay, so here is the S&P 500 that we all know. What you're looking at here is what we call the secular bear market within the period of basically, this is from you can see here 2000, let's say the year 2000, internet bubble, all the way really until we came out of it here in 2013, which was like over here. But this is a secular bear market, meaning we had big bear markets from a cyclical perspective, big cyclical bull markets, and so on and so forth. And so you can see it's very, very volatile. But it's not just volatile within the long-term market. This is a long-term bear market, right? A secular bear market. But even these markets within here, these bear markets, you can see they're very, very volatile. Like these move backs, these rallies back are very, very strong, 20% plus in to some point. So one of the big issues that people have when they play the equity market from on the short side in bear markets is that they get stopped out. And so, because the volatility is so extreme, so just when they think it's time to add to a position, then they get stopped out because the market keeps rallying, or they short the lows, in which case they get stopped out every single time because they can't stomach that volatility. Now, there's one way around this, and I'm actually about to I'm about to launch a special course, a special group on how we can take advantage of that using equities. But for the most part, I think this is very difficult. So let me juxtapose that to the bond market. And for that, we're going to go back to a chart. In this case, we're looking at the bond market. Now, this is a long-term chart, literally like 30 years plus of the bond market, basically bond yields going lower. And I know you might not be able to see this. It may not be so apparent, but the volatility is much, much less. And so if you want to make money in a bear market, I think there is a much safer or a much saner trade to do, and that's basically being long bonds, or in this case, short bond yields. That's the same trade. Now, there's some very specific ways we can do this. Basically, there's futures contract or even options of futures, and it's something that may be a bit beyond the scope of what we're going to talk about here. But basically, equities are much, much more volatile in bear markets in terms of being able to stick with a trade here and making money than the bond market is, where you can lever this up. So a lot of people say, oh, well, volatility equals opportunity, and that's true. The problem is most people get over levered and they don't make money. Whereas in the bond market, you can get just as levered and you have much, much less volatility. So I know this may be a bit of a new concept for a lot of people, maybe something you want to ask questions about. So I'm considering holding a special session on that, special webinar. We're actually maybe forming a small group that'll be a paid members group, where we might take advantage of of basically a thematic trade we might be able to manage and keep on for the next few years, where interest rates are going lower, bonds higher, where we can lever just as much as in the equity market, in fact maybe more even, and make a ton of money. So but really the point of this video was to kind of show you the idea of the equity market being much more volatile than the bond market, and how the equity market isn't always the solution to make money, particularly in bear markets. So if you guys have any questions or concerns, leave it down below. I'm happy to answer that. If you like this, give us a thumbs up, and subscribe to the channel. Talk to you soon.